Discover the world of stock market investing, with A Beginner's Guide to the Stock Market. 1. The Stock Exchange and its Role. The stock market, a formidable yet fascinating concept, rife with intricacies and a rich historical legacy. Let us delve into the essence of this critical aspect of the global financial system, illuminating its definition, tracing its evolution and clarifying its purpose. The market is a veritable bazaar of equities, where investors buy and sell shares of publicly traded companies. These shares, representing a sliver of ownership, offer a pathway for individuals to partake in the prosperity in progress of a company. The Amsterdam Stock Exchange, established centuries ago, served as the birthplace of the stock market and marked the genesis of its storied history. As time marched on, exchanges multiplied and electronic trading revolutionized the stock market, elevating it to its current status as a vital cog in the financial machinery of the world. The stock exchange serves dual purposes. It affords companies a venue to raise capital by issuing and selling stocks, while simultaneously providing investors with a platform to purchase and sell stocks, thereby sharing in the growth and success of companies. The stock market, with its propensity for fueling economic growth and prosperity, stands as a cornerstone of modern society, offering investors the potential for wealth creation through informed investment decisions. The various stock exchanges, such as the New York Stock Exchange and Nasdaq, serve as beacons of commerce, providing a centralized and regulated arena for the trading of stocks. Stock exchanges bring together buyers and sellers of equities, providing an environment of organized trade. They set rules and standards, ensuring fairness and transparency, and offer a plethora of market data and financial news, crucial for informed investment decisions. The exchanges also play host to the issuing of new stocks in the form of initial public offerings, offering investors the opportunity to share in the growth and success of companies through stock ownership. The stock market is a symphony of players, each with a unique role in facilitating the buying and selling of stocks. At the forefront of this grand performance are the various investors, each seeking to realize their financial aspirations through the stock market. Some are individual investors, small-time savers with a modest portfolio. Some are active traders seeking a quick profit, while others are institutional investors, managing multi-billion-dollar funds on behalf of their clients. Regardless of size or scope, these investors are the lifeblood of the stock market, driving demand for equities, and affecting market prices through their buying and selling decisions. Standing between the investors and the stocks they seek to buy or sell are intermediaries, who facilitate the transfer of securities from seller to buyer. These intermediaries, including brokers and investment banks, provide access to the stock market, offering services such as stock research, trade execution, and portfolio management. They also offer crucial investment advice, acting as gatekeepers of information, and serving as a liaison between the stock market and the investing public. 2. Different types of stocks and their associated risk levels. Amidst the complex landscape of the stock market, various forms of equities abound, each offering a unique combination of benefits, risks, and investment opportunities. Common stocks, the most prevalent type of equity, are a testament to ownership in a corporation and convey the right to cast a vote on pivotal corporate decisions. These investments are renowned for their potential to yield substantial returns, yet they are also saddled with the danger of loss. In stark contrast, preferred stocks offer a harmonious blend of bonds and stocks, guaranteeing a steady dividend and precedence over common stockholders in the event of a company's liquidation. Although preferred stocks present a lower degree of risk than their common stock counterparts, they are also characterized by comparatively lower returns. For those seeking a more diversified portfolio, exchange-traded funds and mutual funds offer a plethora of possibilities. ETFs, bought and sold like individual stocks, enable investors to gain exposure to a wide range of equities and bonds, while mutual funds, priced at their net asset value, provide access to a diversified set of investments. Although both options offer a lower level of risk than individual stocks, they also present lower potential returns. Before buying stocks, always check how much volume there is. If the stock is illiquid, consider carefully what the reasons for that may be. To make informed decisions in the stock market, it is imperative to have a thorough understanding of the different types of stocks and their associated risk levels. 3. Portfolio diversification and risk management. Let us delve into the significance of diversifying one's investments, where a multitude of equities, bonds and other securities are strategically interspersed to reduce the dangers posed by putting all your eggs in one basket. By spreading out the investments, it balances the overall portfolio risk, and enables the investors to make the most of the varied economic and market conditions that drive the performance of individual securities. Furthermore, it sheds light on the significance of frequently scrutinizing and realigning a well-diversified portfolio to sustain the preferred level of risk, and make sure that the portfolio is in line with the investor's long-term aspirations and objectives. For instance, if one of your stocks has gone up by 100%, and the other stocks or bonds you have, 5%, it is about time to reduce your position in the runaway stock, as your overall exposure might be too large, according to rules of having a balanced portfolio. However, we at Money Mindset prefer letting your winners fly, and keep a track of fundamentals, technical analysis and future prospects of the company before we eventually sell to take some profits. 4. Understanding financial statements and company performance. The balance sheet acts as a mirror, reflecting a firm's assets, liabilities, and shareholder equity in a given moment, allowing investors to gauge its capacity to settle obligations and spur growth. The income statement is a report card of a company's revenues, expenses, and earnings over a specified interval, providing insights into its profitability, income generation potential, and the stability of its revenue sources. The cash flow statement is a trace of cash inflows and outflows, offering a comprehensive understanding of a company's liquidity and its capability to generate and manage its financial resources. There are also other key financial metrics you should check, such as earnings per share, revenue growth, and return on equity, to assess the company's performance and compare it with its peers in the industry. Additionally, we must highlight the importance of considering macroeconomic factors, such as the state of the economy, inflation, and interest rates, and how they may impact a company's performance. 5. The importance of historical market performance and trends. Understand that the stock market is a cyclical entity and various economic and geopolitical events can greatly impact its trends. Though it's been known to deliver strong returns over the long run, the market can also face short-term fluctuations and periods of volatility. It's imperative to take a historical view when evaluating market performance. Take into account the market's performance during past economic expansions or recessions and compare market returns from different time periods. However, a word of caution, don't make investment decisions solely based on past market performance. We must stress the importance of considering a range of factors such as the current state of the economy, interest rates, and macroeconomic indicators, as well as a company's individual financial performance and growth prospects. So, don't just follow the trend, be informed and make wise decisions. 6. The importance of low-cost index funds and passive investing. We must highlight the value of passive investment and low-cost index funds as ways to achieve financial success. We think that using these techniques offers an easy, effective, and affordable way to invest in the stock market. By investing in a low-cost index fund, individuals can leverage the overall performance of the market and lower their exposure to the risks of individual stock picking. This strategy of passive investing can help individuals achieve their long-term financial goals while avoiding high fees and expenses. We believe that low-cost index funds offer a superior way to invest, as they provide broad market exposure at a lower cost compared to actively managed funds. By following a passive investment approach, investors can reduce the risks associated with stock picking and market timing and enjoy the long-term growth potential of the market. The right approach would be taking a long-term perspective and avoiding the trap of trying to time the market or making short-term investment decisions. It emphasizes that a steadfast commitment to passive investing can lead to long-term financial success. 7. Behavioral finance and the impact of emotions on investment decisions. Investors need to be aware of their own biases and emotions and to strive to make investment decisions based on objective criteria, such as a company's financial performance and growth prospects, rather than on emotions or personal biases. By understanding the impact of emotions on investment decisions and taking steps to control them, you can make more informed and rational investment decisions that are more likely to align with your long-term financial goals. Packed with wisdom gleaned from years of experience and acumen, we will give you all the tools you need for your journey. Delving into practical advice and cutting-edge insights, we empower you to make informed investment decisions, reach your long-term financial aspirations, and chart a course towards financial success. For more ideas on financial books, we suggest watching Best Books for Trading. If you liked this video and want to learn more on how you can improve your financial situation, please subscribe. Money Mindset, Financial Freedom.